Welcome to This Explainer. Today we're unpacking a fascinating and frankly kind of shocking reality about modern money. We're going to break down exactly why some people seem to effortlessly build wealth, while others just remain permanently trapped in financial mediocrity. And the crazy part? It happens regardless of how much money they actually make. If you've ever wondered where all your cash goes at the end of the month, or why true financial peace always feels just out of reach, you are definitely in the right place. So let's dive right into this. $400. We've got to start right here, because the stats from our source material are genuinely alarming. When researchers asked Americans about their ability to handle a basic $400 emergency, they found that 1 out of every 3 people simply cannot cover it. Just really think about that for a second. $400 is less than a standard monthly car payment. Yet for millions of working adults, an unexpected expense of this size isn't just a bump in the road, it's a total financial catastrophe.
So, that brings us to a really fascinating question. Why do even high earners live paycheck to paycheck? You know, it's so easy to just assume that being broke is exclusively a low-income problem, but it's actually not. This kind of financial fragility spans across all income levels, educational backgrounds, and career paths. I'm sure you've met people who pull in 6-figure salaries but are just absolutely drowning in financial stress. Why is that? Well, because financial success isn't just about the sheer volume of money flowing into your bank account. It really comes down to the hidden, fundamental decisions people make with their money every single day.
Figure this all out? Here's our roadmap for today. First, the psychology trap. Second, the daily leaks. Third, the structural flaws. And finally, the wealth building blueprint. All right, let's jump straight into part 1, the psychology trap, the invisible mindsets keeping you stuck.
The absolute crucial point here is this concept of present-focused thinking. Look, I get it. It's incredibly appealing to live entirely in the moment. Life is short, right? But the trap snaps shut when this thinking becomes so extreme that you start making financial choices as if your future self literally doesn't exist. People spend heavily on immediate pleasures and just kind of assume future you will magically figure it out. Well, sorry, future you. True wealth absolutely requires balancing that present-day enjoyment with future security.
That brilliantly illustrates our next psychological trap, the massive difference between looking rich and being wealthy. It's a bit of an uncomfortable truth, but a lot of people make purchasing decisions based purely on what others might think. They lease luxury cars or buy incredibly expensive watches to manage their appearance, basically hoping that projecting success will somehow magically lead to actual success. But here's the ultimate irony. Truly wealthy individuals often do the exact opposite. They drive older cars and live comfortably, but not flashily. Why? Because they know that every dollar spent on a prop for an audience is a dollar that isn't working to generate real wealth behind the scenes. Now, on the total flip side of reckless spending is an equally dangerous mindset, and that's the absolute fear of risk. Some people are just so terrified of losing money that they keep everything tucked away in basic savings accounts earning almost zero interest. They avoid investing entirely. But here's the catch. Avoiding all risk is actually a highly risky decision, because inflation is quietly and predictably eroding your purchasing power over time. So playing it safe in this context actually guarantees a loss. Moving right along to section 2, the daily leaks. Tangible habits draining your wallet. Let's actually bring the math to life here. Consider something like a pack-a-day cigarette habit. People often don't recognize expensive daily habits as massive wealth transfers, but they absolutely are. At $250 a month, that doesn't just equal $3,000 a year. Over 10 years, you're looking at $30,000. And that isn't even counting the compound growth that money could have generated if it had been invested instead. The exact same logic applies to buying lunch out every day or constantly ordering takeout. These aren't just small little treats. They are massive obstacles to building your wealth.
So, how do you actually catch these wealth transfers? Well, you need a spending plan. Most of us would never dream of running a business without tracking income and expenses. Yet we run our personal finances with exactly that level of carelessness. Without tracking where your money flows, it's completely impossible to catch those $5 impulse buys, the daily coffees, or those forgotten streaming subscriptions. A solid spending plan spots these hidden leaks before they sink your financial ship.
Another huge leak comes from totally misunderstanding debt. Most people treat all borrowing as basically the exact same thing. But there is a massive, massive difference between productive debt and destructive debt. Productive debt actually helps you acquire assets that generate income or appreciate over time. Think of things like a mortgage on a rental property or a strategic business loan. Destructive debt, on the other hand, is the exact opposite. We're talking about money borrowed to buy items that lose value instantly and give you absolutely zero ongoing financial benefit. Think about putting a vacation on a high-interest credit card.
or financing consumer goods you can't actually afford. This type of debt doesn't just charge you crazy interest, it stretches your monthly budget way beyond sustainable limits. It creates endless financial stress and completely locks you out of the ability to invest.
Which brings us to Section 3, the structural flaws, systemic barriers to wealth. So, what exactly are these systemic errors? Well, they usually boil down to a few core structural flaws. People operate without clear financial goals, which makes every single spending decision completely arbitrary. They pay everyone else before paying themselves. They rely exclusively on trading their time for dollars. And perhaps worst of all, they just completely stop learning about money the second they leave high school or college. Financial markets, tax laws, investment opportunities, they change constantly. If you aren't updating your knowledge, you're literally operating with an outdated map.
What's really fascinating about all this is that fundamentally, most people approach their finances completely backward. I mean, think about it. You get a paycheck, you immediately pay your bills, you buy groceries, and you fund your current lifestyle. Then you just sort of cross your fingers and hope something will be left over for your own future at the end of the month. But this is actually a textbook example of Parkinson's Law. Your lifestyle expenses will always expand to consume your available income unless you actively intervene. When your financial future gets last priority, let's be honest, it usually gets absolutely nothing.
All right, let's fix this. Section 4, the Wealth Building Blueprint, your actionable turnaround. Here is your blueprint. First up, set specific targets. Don't just say, oh, I want to save money. Say, I want to accumulate 15 grand in 18 months. Clear targets act as a harsh filter for every financial decision you make. Next, track every single dollar you spend for just 1 month to reveal your true habits. Then, tackle your highest interest debt first, using a strict mathematical approach, while absolutely avoiding any new destructive debt. Finally, focus on building passive income and continuously educating yourself.
But let's get even more immediate than that. If you're part of that 1/3 of Americans who can't handle a surprise expense, your first step is incredibly simple. $50. Start an emergency fund today with just $50 if you have to. This isn't just about covering a broken washing machine. It's about breaking that vicious psychological cycle of going into debt every single time normal life throws you a curveball.
Next, we have got to fix that backward money flow we just talked about using the pay yourself first system. It's 3 simple steps. Step 1, your paycheck arrives. Step 2, you immediately auto-transfer a set amount to your investments and savings. Step 3, you pay your remaining bills and expenses with whatever is left. By automating this entire process, you force yourself to adapt to living on less than your full income. You secure your future first, which naturally makes you far more creative and selective about how you spend the rest.
Now, as you optimize your spending, you absolutely must optimize your earning. This blueprint requires a major shift from linear earned income to passive income streams. Broke people tend to think working more hours is the only way to earn more money, but wealthy individuals, they know true freedom comes from income that doesn't require your direct time. Things like rental properties, dividend stocks, or a scalable side business. Yes, making this transition requires reducing your current consumption in the short term to free up resources to invest, but those sacrifices are the absolute key to long-term freedom.
Which brings us to our final thought for today. The path from being broke to being financially secure, it really isn't some deep, dark mystery. It doesn't require extreme luck, and you don't need a massive inheritance. It just requires systematically replacing wealth-destroying behaviors with wealth-building habits. As our source material powerfully concludes, the question isn't whether these principles work, it's whether you'll apply them consistently enough to see the results. So I'll leave you with this. When you log in to check your bank account exactly 1 year from now, will it reflect your future goals or just a history of your momentary impulses? Thanks so much for joining me for this explanation.